Hello, everyone, and welcome to the episode number 34 of JustDario Cigar Time. Today, we are going to perform an anatomy. To be precise, the anatomy of a perfect storm, combining silver squeeze, Lbma vulnerabilities, and systemic consequences. We are witnessing a historic convergence in the silver and gold markets right now. Last Friday, on July 11, silver prices surged to $38.37 per ounce, reaching a 13 years high, representing a staggering 24.68% increase in price year to date. But this price spike is merely the visible tremor before a potential financial earthquake. Beneath the surface, the London Bullion Market Association, that is the cornerstone of global precious metals trading, faces unprecedented strain. Physical inventories are evaporating while paper claims multiply alarmingly. As per latest figures, as of mid-2025, Lbma vaults hold just 8,776 tons of gold and 23,791 tons of silver to back trillions in paper contracts. The so-called free float, that is the actual unencumbered metal available for trading, has shrunk to dangerous levels, with some analysts estimating the paper-to-physical ratio in silver reaching an unsustainable 378 to 1. This means that for every ounce of real silver, there are 378 times more paper claims demanding ownership. Silver is clearly facing a perfect storm. Industrial demand for solar panels, electronics, electric vehicle already hit 680 million ounces in 2024, while investment demand is surging relentlessly. Silver ETFs added 771 tons in June 2025 alone. Yet, supply remains constrained, with the market now in its fifth consecutive year of structural deficit. The Silver Institute projects a 149 million ounce shortfall for this year. This gap is large enough to swallow 17% of annual production. If this deficit persists, despite mine output reaching a 7-year high of 844 million ounces, it's potentially catastrophic. And on the other side, it reveals the sheer scale of the demand right now. Why there is potentially a free float trap and looming domino effect? So, free float represents the beating heart of market liquidity. The physical metal that is not pledged as collateral, leased out, or trapped in transit somewhere. When this free float shrinks, the entire system becomes vulnerable to an equivalent of a cardiac arrest. The Lbma's pledged and repledged system, where we know the same silver bar is counted multiple times across different owners, has created a speculative hole of mirrors. Lease rates, the cost to borrow physical silver, spiked above 6% recently. And let's not forget, these are levels not seen since the 2008 financial crisis. This is the market's fever spike, indicating severe physical distress. When investors lose faith in paper proxies, like ETFs or future contracts, and demand physical delivery, bullion banks like JP Morgan, HSBC, or UBS must scramble to source the metal. But vaults right now reveal alarming emptiness. COMEX warehouse stocks total just 320 million ounces, while Lbma holdings hover around 1.2 billion ounces, much already encumbered. The waterfall declines in silver during US trading hours, that means sudden 3 to 5% price drops, aren't natural volatility. They reflect desperate paper silver dumps by institutions trying to suppress physical delivery demands. This creates a self-reinforcing doom loop. every failed delivery destroyed confidence, triggering more physical claims. And when Trump announced sweeping tariffs in April 2025, silver instantly plunged from $34 to around $30, not due to weakened demand, but because leveraged paper positions were liquidated to avoid collateral costs. Yet, physical premium at coin shops and the physical market simultaneously surged by roughly 15%, proving the deepening chasm between paper and physical markets. Bear in mind what I just said, because I want to refresh everyone's memory and talk about the nickel crisis and how it can be a blueprint of what it can happen in the silver market in the near future. Back in March 2022, the London Metal Exchange nickel market imploded when prices surged 250% in 24 hours, forcing the LME to halt trading and cancel $3.9 billion in contracts. This was a catastrophic short squeeze amplified by critical vulnerabilities. Critically low exchange inventories, massive concentrated short positions, and industrial users panic buying to secure supplies. The parallels to today's silver markets are chilling. Just as nickel stocks covered less than 3 days of global consumption in 2022, LBMA's free float silver inventories could satisfy less than 1% of outstanding paper claims if delivery demands surge. Bullion banks today are estimated to hold net short position exceeding 800 million ounces in silver future. And this is an insane speculative bet against the physical reality. The nickel crisis proved exchanges will sacrifice market integrity to save systemically important players. When the LME voided trades, it prioritized protecting banks over honoring contracts. The LBMA now faces an identical dilemma. With President Trump's trade war escalating, industrial users are stockpiling silver. Solar panel manufacturers alone consume 232 million ounces annually, with each new TOPCon solar cell requiring significantly more silver than older technologies. If solar installers, chip makers, and electric vehicle manufacturers that use 25 to 50 grams of silver per vehicle simultaneously rush to secure physical metal, the LBMA could freeze withdrawals or void contracts within days. Furthermore, Mexico's recent mining reforms already threatened 5% of the global silver output. Beware, when a catalyst is gonna hit, the nickel playbook will replay in precious metals, trading halts, forced cash settlement, and broken promises to physical holders. A full-scale physical silver squeeze would unleash financial sharpnel across multiple sectors. Bullion banks will face catastrophic losses if forced to buy silver at crazy prices like $100 an ounce or more to cover shorts entered at much lower level, many of them below $30. Conservative estimates suggest that a significant spike in prices could immediately trigger more than $50 billion of losses. Derivative books laden with unmanageable physical delivery risk would implode first. The LBMA and COMEX will face legal avalanches as delivery failures trigger failure to deliver clauses. Exchange default funds designed to cover routine defaults will prove inadequate against systemic failures. Potential liabilities could exceed, in some estimates, $200 billion when accounting for industrial supply chain disruptions. The solar industry could face production paralysis, with panel manufacturers needing 20 million ounces monthly and inventories near zero. Factories from Shanghai to Arizona will idle within weeks. Miners would ironically suffer too, because they are locked into fixed price forward contracts signed around $30, $35 per ounce of silver, even as spot prices surge past $80. The so-called physically baked ETFs like SLV will reveal their dirty secret. Prospectuses allow leased or hypothecated bars, meaning multiple owners claim the same metal. When redemption demand hits, fund suspensions will trigger class action lawsuit. What is the weakest link? Lbma clearing members have rather thin capital buffers. If silver volatility significantly spikes above 60%, margin calls could vaporize undercapitalized traders overnight. Remember, nickel's 250% spike in 24 hours almost broke a 146-year-old exchange. And if silver reaches $100, it will represent a 300% price surge from 2024 lows. Let's discuss two potential scenarios now. One that we call a managed meltdown, and the second one, a total systemic failure. In the first scenario, what is going to happen will be the equivalent of a controlled demolition. Central banks and regulators will intervene to contain the blast radius of the implosion. The Federal Reserves will likely activate swap lines and liquidity injection to bail out the system. The Lbma will impose delivery rationing, allowing, let's imagine, only 10% of contracts to settle physically. COMEX will force cash settlement on all silver contracts, betraying physical orders but preventing vote exhaustion. Bullion banks will effectively receive covered bailout, labeled as market stabilization funds. In this scenario, prices will stabilize artificially. Silver might spike briefly to $50 or above before being capped. Physical premiums will surge to maybe 100% or more over paper prices. But trust in exchange will eventually survive. Miners will enjoy a windfall in profits, but will face political pressure to ramp up their production and flood the market. However, because of prices increases, solar panel costs, chips, EVs, prices will jump significantly. Overall, this system will stagger forward, wounded, but eventually remain functional. The second scenario, that will eventually be a worst-case scenario, is going to be the one of an uncontrolled implosion. Panic will overwhelm attempts of bailouts. Physical delivery demands will exceed Lbma stocks by an incredible amount within few days. Both doors will literally be slammed shut as custodians are going to declare force majeure. And then you can imagine the madness on social media and investment market and mainstream media with the silver squeeze hashtag going viral and people jumping to trade this opportunity and amplify the market movement, eventually maybe creating something similar to what happened to the incredible GME days many years ago. Here is what a nuclear chain reaction can look like. Precious metals derivatives will freeze as counterparty risks explode. Banks will demand physical collateral even for routine trades. Industrial shutdowns will spread from solar to electronics to auto sector as silver becomes unobtainable at any price. Fiat confidence implodes as silver and gold will start becoming de facto currencies for bilateral trade. And then, in this situation, alternative solutions like a central bank digital currency will start accelerating, enabling programmable money that extinguishes financial privacy and used to plug all those massive holes that have been created. All I described will not just be a metal crisis, will become a legitimacy crisis for the entire monetary architecture. When paper claims for metal prove worthless, why trust dollar-denominated debt? The Lbma own 2025 survey reveals 95% of central banks expect to increase their gold reserves already, and 73% foresee collapsing in dollar dominance. We already see that a lot of retail missed a big chunk of the gold run, and they see silver as a monetary alternative to preserve their purchasing power. So a retail avalanche into this market can result in insane consequences for the whole fiat monetary system per se. Listen carefully. People from trading floors to streets are starting to grasp what the Lbma dares not to admit. When paper burns, metal endures. The potential incoming squeeze isn't merely a trade. It might potentially be a referendum on trust itself. And as the nickel crisis proved, when trust evaporates, the rules shatter with it. The votes won't save us. Only what we hold in our hands, in our safes, potentially will. Thanks a lot for listening to my podcast today, for liking the video, for subscribing to my YouTube channel, for supporting me on X, and for kindly reading and commenting my articles on JustDario.com. I wish everyone a nice week ahead.